The Online Business Exchange was a two-day live event presented by the Business School at the Open University. During the event, there was live chat and forum discussions. The live chat is now closed, but we hope you enjoy the video that follows. Hi and welcome back to the Online Business Exchange. In this session, I am joined by Devendra Kudwani, who was in our previous session, and also Alan Shipman is also joining us, who is from the Economics Department and has written Capitalism Without Capital. I always get this the wrong way around. I'm very sorry. So this will be a very interesting discussion because what we're going to focus on now is what's happening in terms of finance in the digital economy, and obviously very relevant in terms of cashless societies, etc. So, Alan, could I start by asking you about some of the key things from an economic perspective that you think are most relevant in terms of finance in a digital economy right now?
Well, I'm paid to worry about the financial sector, and that leaves me in the rather unpopular situation of worrying about the condition of banks, especially the high street banks that we've traditionally regarded as sort of solid and profitable and always there to provide finance for industry. Devendra was mentioning in the earlier session, you don't necessarily need to go to a bank anymore. There is peer-to-peer lending, there's crowdfunding, there are other ways in which savers can connect to borrowers and businesses can get funding. And that's one of many things troubling banks at the moment. Where do they fit in? Because they traditionally were the only people you could go to for credit. There are a number of other problems that banks are up against. The aftermath of that financial crisis, which almost brought some of them down. The extra regulation they have to deal with as a result of that. The capital requirements that have been upped substantially. And, of course, continued problems in the economy that they're dealing with, which are an aftermath of that financial crisis and a product of other troubling events that have happened since. So in this situation, although it's very exciting to look at the new opportunities for new entrants in the financial sector and for borrowers and for savers, one also has to look at this big legacy of the banks we've got. And the message that economists bring is that you can't get rid of banks. They do something special. That banking license they've got literally is a license to create money. And if they're not able to operate in the traditional way, there might be a drainage of demand from the economy. There might be a seizing up of some of the wheels of commerce, which do depend on banks' unique ability to lend out money which is created, as distinct from just taking savers' money and sending it over to lenders. So that's my concern. A lot of exciting things happening in the digital economy, but it may make life for traditional banks more difficult, and we might suddenly realise they were doing something important that we'd forgotten about.
So your take really on this digital economy is this cashless transactions in terms of how banks are shifting money around?
Yes. Financial technology, all this innovation is really building on the basic products that banks do. Current accounts, the traditional payment system that they operate, and this act of lending, and the very special way in which banks lend money that they don't have, as distinct from money they've collected from others in the economy. It's great to be building all these things on that infrastructure. We have to look at whether the infrastructure is viable and whether the sinking profitability of banks is actually going to be a problem in the future.
Okay, interesting. So really this is all about banks. Devendra, what would you say in response to this?
I agree with Alan that banks are facing a challenge, and this shows the disruptive power of technology if it takes on. So I think it is, if one goes back, it's probably similar to the way energy evolved once you had steam engines, what happened to the people which were, who were providing energy through manual force. So I think we are in for a shake-up in the way the finance is floated and moves around in the economy, and banks traditionally have played a very dominant and important role, and I agree that with Alan that they do have some value adding. Even the kind of example that we were discussing is like crowdfunding or cashless society. Cashless society may appear on outside it is cashless, but behind the scene, what you and I as consumers would not see. Somebody is processing, making sure that payments are going through, the contracts are being honored, and customers and suppliers are getting the money when they should be getting, and so on. So there is behind cashless society is infrastructure which is reliable, and there's an integrity of that system to work for the economy, so that people are getting what they should be getting through the transaction. So obviously there is this need for banks to survive, because they are the backbone, behind the scene backbone of operations, flow of money in the society. And also they create this, the velocity, what Alan was alluding to, is a cycle of credit, the lending. And then that can be a kind of a negative consequence of, for example, crowdfunding. So if I and you do not go to banks and deposit our money and directly invest with small business size, small size business or medium sized business, because there is hardly any intermediary, then it takes out the role of intermediary who create credit lending. And so, of course, when they go overboard, they end up creating subprime kind of a crisis. But if they do it judiciously, diligently, that is a useful function.
So if we were to look then, we're looking at the future in terms of ways of funding things and also some of the implications. But if we were to look at some of the past issues as well in terms of how the banks have been operating and how the economy was managed in that time of inflation and lending, etc., what would some of the learnings that we could be what were some of the learnings from that? And then what are some of the implications in terms of how we're looking at the future? What are some of the issues that we need to take from that?
It's always tempting to look back at the crisis of 2007, 2008 and the re-regulation of the banking sector that followed and think that was really when things went wrong. But I think we have to look at why did things go wrong at that point. And what we saw was effectively an earlier stage of banks losing some of their core business and having to do newer, riskier things in order to stay profitable. Well, a number of factors fed into that crisis, but one of them was that high street banks had lost a lot of their bigger business opportunities to investment banks, sometimes part of the same group, but sometimes standalone. They were doing the big business lending, and the commercial banks, the high street banks, were really left looking at small businesses or households. And the big thing that they could do with households was lend to people to buy houses. So they moved into a mortgage lending area, which really commercial banks hadn't been involved in initially. That was the province of building societies, other specialist lenders. Banks marched in apparently very successfully, especially when they found that new way of making loans to customers, bundling those loans up, selling them off into a high street, into a wholesale market, and apparently moving that risk off their books, and therefore making riskier loans than they had before, profitable loans if they were paid back, apparently low risk if they'd sold the risk on appropriately. That arithmetic just fell apart. They found that they got a lot of bad lending. They needed state-subsidised rescue because of the extent of that bad lending. They're still recovering from that. But it was really a symptom of banks looking for a role because they'd lost some of their traditional business to other parts of the financial sector. And this is happening all over again now with financial technology, these innovations in payment systems, innovations in systems of lending. Banks are left with a certain amount of business providing ordinary current accounts, providing their legacy payment system, which isn't necessarily going to be profitable for them. And so they have a choice really of, do they move into these new areas and try and compete with the new providers, or do they find some sort of accommodation with them? And we're seeing elements of both of that at the moment, including banks moving into the making of loans via peer-to-peer lending, which is an interesting development. They're trying to co-opt something which ostensibly is competing with them. But it's very difficult, and it's still left them in a situation where they're being cherry-picked essentially by new providers which can take their more profitable customers, depositors and lenders, leave them with the rest. And banks end up looking a bit like a social service. They're expected to provide basic accounting facilities to everyone. A lot of those are not profitable customers, but they're left with them. And they are also under very heavy regulation as a result of their past indiscretions.
Now, this is a very interesting point. It's something that's come up in the chat, actually. Starling Atten has raised this question about these smaller banks and saying, are they mostly, the new providers, are they mostly for businesses or consumers? And a very interesting question, are they good?
We're still waiting to find out. Encouraged by government, there has been a lot of entry into the banking system, challenger banks and also new forms of financial institution which are not banks in the sense that they create credit. They don't have banking licenses, but they are doing the intermediation, linking savers and borrowers, which banks also traditionally did. So a lot of new providers have moved in, and we're waiting to see, firstly, do they become anything more than niche providers, because the big banks are still doing most of the borrowing and lending in the economy. And secondly, do they, even if they remain small, do they create a problem for the existing banks, or do they create a way forward and actually, in the end, make the whole system viable for banks and better for customers? It's really too early to judge that. And I would also bring in a major caveat that we've seen very rapid growth of these new providers, including crowdfunding, which is causing a lot of excitement. But it's all happened in a very unusual environment of zero interest rates. Interest rates globally have been pushed down to historically very low levels as a way of dealing with the financial crisis. And there's no sign of those interest rates rising much above zero, the base lending rates set by central banks. This is historically unique. And it means that there is a lot of very cheap capital floating around in ways that we've never seen before. At some point, probably, interest rates will start rising back towards where they used to be, which is much higher. And at that point, I think we might see a shakeout of an already crowded space. There's going to be a shakeout anyway, because when something new comes in, a lot of providers go in, only a few will survive. But the extra dangerous element is one day that cost of borrowing is going to rise, and it's going to be a very difficult adjustment after a very long time when interest rates are close to zero. So that's the second thing we have to watch. And it's really unknown territory. We haven't been in this situation of actually interest rates possibly having to go negative in some regions in the near future because of the very delicate state of the global economy still.
Have they ever been negative before?
In real terms, yes. I mean, there have often been times when the inflation rate, prices rising, is higher than the interest rate. And so in real terms, interest rates can go negative, and that can be good for the economy. The problem we have now, it never used to be a problem, but it is now, is zero inflation. Mildly falling prices, negative inflation in some areas like the Eurozone. And that means that the central bank's traditional weapon, which is rescuing the economy by pushing lending rates down, has really been exhausted. We got them down to zero, but if prices are falling, that's still a positive real interest rate. And central banks are starting to experiment with that negative interest rate, where you would actually be charging people for depositing their funds rather than paying them interest for depositing funds.
Would we be the only ones then if there was to be a situation where there were those negative rates?
Japan is having to look at this. The European Central Bank is having to look at this. In the aftermath of Brexit, the Bank of England may have to look at this. Essentially, we want inflation back because that's good for borrowers, less good for lenders. But to get the economy growing again convincingly, we need conditions to be better for borrowers. And that means inflation rates which hold down that real cost of borrowing. We haven't got that at the moment.
Dev, what's your take on all of this from a more practical perspective?
I think from practical perspective, if you look at it from a small and medium-sized business owner, they will have, on one side, capital available at low cost. But at the same time, if the demand is not boosted, as Ellen is saying, that we are seeing a fairly fragile economy at the moment for most consumer and industrial goods, then it's a problem of even if you have capital, how do you grow your business? You know, so that's a challenge. But at the same time, it is creating some different. If I go back to the micro level of financing from the crowdfunding, we are finding in the crowdfunding is not just the commercial projects that are being funded. It's different type of projects. Social enterprises are being funded. So now they might be a small portion of the total economic value that we have, but they are funding projects which are small entrepreneur. An artist wants to create an album, music album, doesn't find any buyers from the major music companies, and he goes out and pitches to millions of interested people. Only few would support. So maybe he would get backing from 500 people, and he would just create, or she would create 500 DVDs and send it to only the backers. So it is creating all kinds of innovative ideas. Some social enterprises that are being funded would have found no funding from the traditional banks because the rates of return on those, the risks will be high. Even venture capitalists won't go to them because the projects that they are thinking about are not necessarily commercially viable. So I think crowdfunding is in that sense creating opportunities for those people who do need funding, but not necessarily for making huge profits. And this is where it is becoming quite innovative, I find. One of the platforms that I looked up claims that they have allowed, enabled mobilization of $2.4 billion for over 100,000 small projects to medium projects. I mean ranges from under $1,000 to $2-3 million project. And one that excited me was funding of production of a social robot, which is exciting.
Yeah. And a huge change for ordinary people to have that concept of engaging and investing with business.
Yes, I think this further brings, I mean, it's not new thing that ordinary small investors are interested in the financial markets. We have historically, Britain has led the world in terms of creating millions and millions of investors. But this is going way beyond it and really capturing the attention of people who are just interested in backing ideas. They think they want to take risk. And it's going down to investing $50, 50 pounds to 50 euros kind of amounts we are talking here, which is very, very exciting, yes.
What about this idea of crowdfunding then?
It is not, in a way it is not new. If you look at the way traditionally we have raised funds, they have come either from banks or directly from the stock markets. Companies have gone out and made pitch to potential investors who buy shares. So in a way, issuing millions of shares to thousands of investors is a kind of a crowdfunding. I think what's new is that it is outside the remit of formal regulation, and this is where the risks might lie, and this is where some important functions of regulations might be important.
And the terms are very rigorous, aren't they, in terms of ensuring that people deliver on those investments? On investments.
Yeah. So the prospectus of a regular offer from a company would be very, very different document than a pitch, which might be a YouTube pitch from an entrepreneur that this is the product I want. Effectively, it's like Dragon's Den program on BBC, where you have four potential entrepreneurs sitting with pockets of money saying that I would invest in this project. Instead of Dragon's Den, you have here millions of Dragon's Den entrepreneurs. Everybody, yes. And everybody is willing to listen to your pitch and then back it up. So in a way, it democratizes the risk sharing, the participation in risky ventures and so on.
Okay, excellent. But there are some things to be wary of. And Alan, I know that you were saying that in terms of some of the technologies, there are some things that as business people in business we should be mindful of. I wonder if you can tell us a little bit about some of the financial technologies and some of the issues around some of that.
Financial technology. It's become a bit of a buzzword, and it's meant different things at different times. But essentially, there's a lot of friction and a lot of inefficiency and ignorance still in the financial system. People, if they've made overseas payments or tried to recently, they probably found it's expensive, there are delays, there's a lot of bureaucracy. It should be easier than it is to transfer money from one place to another, even if it has to go from one currency into another at the same time. And there is a tremendous suspicion that banks are holding back on the efficiency improvement that they could make because essentially they used to charge a lot for this service. It's much lower cost to them, but if they can keep those charges up to the customer, they just make more profit. That's the red light, the green light even, for new entrants to come in and set up payment systems which just get rid of that friction using the new electronic technology, charge less and take the business away from the banks, or force the banks to go into alliance with them so that they can deliver this lower cost transfer payment method. There's a huge amount of innovation. I can't reel off names of companies, but there are many, many startups looking at more efficient ways of transferring money, that very simple but very important basis to every transaction. We've got companies that have been around for a while, like PayPal, which were doing this as these new electronic technologies first came in. But there are now companies moving on from that, realizing there are even more efficient, quicker, cheaper ways of doing it. And they would see this as taking the friction out of the system because the technology now allows us to do this. The problem I was alluding to earlier is it does take potentially a big source of profits away from the banks. And if they are not the ones using these new technologies, if that's gone to new entrants, it leaves the banks struggling to make good that profit stream in another way. There are other hazards as well. And traditionally, there have been a lot of checks and balances within the financial transfer process for a very obvious reason, that there can be fraud, there can be theft, all sorts of things can go wrong. So there's a need for a sort of cumbersome verification process very often. And as that becomes electronic, the hazards rise. We hear about hacking, we hear about identity theft, all sorts of ways in which if they're not seeing each other, if they're just transacting at a distance, people might be tricked or perpetrating tricks. And so there is necessarily a sort of bureaucratic checking element, but it may be harder to do that when it's gone electronic than it was in the traditional way when you actually had to go in and talk to people in banks and fill forms in and have signatures verified and so on.
Yeah, so Dev, how are businesses then dealing with some of these issues of theft and you know, managing that whole process?
Yes, I think one of the things most businesses would need to pick up as a kind of core competence, which will become a basic service function in most businesses, the cybersecurity. Because whether we like it or not, every part of the business transactions, the whole supply chain functions that business performs is electronically managed or interfaced. Therefore, all the risks that Alan has just now listed are real, genuine risks, and I think we as a society, as an economy, will need to gear up in terms of making sure that the cost and the time required for high quality security servers, the knowledge that people need to have for using that technology, it's important aspect of business function now. So risk management, particularly on the technology side, will be an important aspect that businesses will need to look at. And again, this is where learning can come in, because I know that one of the most popular MOOCs that Open University put out was on cybersecurity, and millions of people have benefited from that thing. So again, it's moving with time. What are the new functions that you need to add to your business portfolio? And I think cybersecurity and electronic security is one of the key things.
And even on an individual level.
Absolutely. I mean, we need to be mindful. I mean, it's on one side it is exciting. So as a parent now, I have a separate account on parentpay.com, which manages only schools payments between schools and parents. So there will be niche kind of platforms and payment processing systems and so on. So it does complicate life, because I need to now know what's the quality of security on my servers at home. You would need to worry about your laptop is secure or not, and to be able to pick up those cues and signals. So again, it goes back to that in digital economy, it's not just as a consumer that you need to be careful, but also as just a living person with interacting with.
There's even pocket money systems now where you can pay your children electronically.
Yes, you can. you can have that thing. So and then you don't know what they are doing. So if you just paid them in form of a plastic card or a digital account, and you don't know where it went. It's difficult to find what's going on with all kinds of games and people out there on the internet, how they are using that money. So it poses real challenges for parents, for business people, for us in a university. We are facing a similar type of challenge, that how do we know people are submitting their own work, for example, electronically.
Excellent. Well, Alan Shipman, Devendra Kudwani, thank you. That has been a really interesting discussion, and just the start of a discussion as well, because we'll be picking up some of these themes. We do hope that you can engage on the chat. I'm just going to see how that widget is looking, because we asked how you were feeling right now. And I'm very pleased to see that there were a lot of very positive emotions. People were saying they're feeling positive, calm, engaged, ready to learn, intrigued, curious, joyful. I like that. And somebody was feeling frustrated. Let us know if that's to do with the economy, finance, or something that you're experiencing with this event, because we are manning that inbox. So do let us know if you've got any questions or concerns that we can help you with. Please do chat as well. I know that a lot of you are watching in the watch-only option. it really will limit your experience of the event. And so if you can come into the Watch and Engage by re-engaging with the website, selecting Watch and Engage, and then using the normal login details that you would use if you were a student, or if you're not a student, you can get an Open University visitor account, which is really simple and easy to do. And there is a link there on the frequently asked questions section of the website. There's also a short video about the interface so you can see what will happen when you join, but it's a great way to see what other people are talking about. But I'd like to know now what you thought. What are your thoughts on this session? We've raised a lot of issues, and a lot of those, you know, many people are saying that they're in full-time employment. How does this impact on you as an employee, maybe as an individual, maybe as a parent, in all these various roles? Financial aspects of the digital economy are having a huge impact on the way that we're operating in society. So let us know your thoughts on how that's impacting, and we can continue that discussion also later on Yammer today, but just type those in the chat box and that'll be really interesting. We're going to have a short break now, and we're going to have the chat open for about a quarter of an hour or so, and then Devendra will come back and we're going to talk about corporate society and corporate governance and the impact that that has in a financial context in this digital economy. So have that short break on chat. Let us know what you thought of that last session, and are there any interesting aspects if you're in a large enterprise where corporate governance has an issue, is an issue for you. Let us know the questions, and Dev will be talking about those in a few moments with us. But we'll leave the chat open. We'll see you back in about 15 minutes, and I hope you're enjoying the programme so far.